Most ETF portfolios I see are more complicated than they need to be, and in many cases that complexity has quietly been costing people money. Here are 5 mistakes you can fix in one afternoon. We have many choices these days when it comes to picking ETFs, but I think sometimes we have too much choice because one of the biggest issues I see with ETF portfolios is overlap. One of the most common instances of this is overlapping exposure to the USA. So when people are choosing between picking the global ETF or the S&P 500, they're not quite realizing that in the global ETF, they've already got around 60% weighting towards the USA. So then by picking both, because they simply can't decide between them, they then increase that 60 if they go 50-50 to about 80% of their portfolio. And this can bring about a big concentration risk in just a small handful of companies. You've got the likes of Nvidia making up about 4.5% of a global ETF, and that reflects where they are in the global stock market right now and the performance that they've had. And companies will get reweighted depending on how they perform in the future. But if you're picking a global ETF because you want good diversification and a very hands-off approach, if you're then picking an S&P 500, which is going to have an even higher weighting towards these big tech stocks, then you're actually reducing your diversification because you're putting even more of a stake in just a small handful of big companies. And sometimes investors take this one step further by also including the Nasdaq 100, and the Nasdaq has an even higher weighting towards these big tech stocks. We do also see this in other markets as well, for example in a European ETF, which has about a 21% exposure to the UK. So then if you're also adding a UK ETF such as the FTSE 100, then you could be increasing your exposure more than you realise. Currency hedging has been a big talking point this year, especially for UK investors. That's because the value of the US dollar has fallen against the value of the pound. That means UK investors who invested into the S&P 500 are seeing that the index has made multiple all-time highs this year, and then they're looking at their portfolio and wondering why they haven't got the same returns. And that's because in order to buy a US index or any US companies, you have to convert your GBP into USD in order to buy those stocks. Then when you come to sell it, it then gets converted back. So you are at risk of any currency fluctuations in the time that you hold those investments. But over a long period of time, this tends to even out. Currency hedging can be useful if you've got a time horizon of around 2 to 5 years, so slightly shorter, because you haven't got the time that if it did go against you, for it then to even out and come back into your favor. But for most long-term investors, a lot of hedge products can be more expensive than an unhedged version, and actually you've got no extra benefit if you're investing for a long period of time anyway. The other thing people confuse is denomination with exposure. For example, in a global ETF, they're usually denominated in the US dollar, but that's not the same currency risk as investing into the S&P 500, because in a global ETF, that investment has to be spread all over the world in different regions with different currencies, and that's where the currency exposure comes from, not the denomination of the ETF itself. Leverage ETFs have become very popular over the last few years, but they can be hugely damaging, especially to long-term investors. And that's because when investors look at leverage ETF products, they see a 2x or a 3x, and they assume that that just amplifies all of the returns long-term. So for example, if the S&P 500 does 10% 1 year, they then assume that if they've got a 2x leverage ETF, they'll get 20% return. But it doesn't work like that because it gets reset on a daily basis. And that may sound like quite a subtle detail, but this comes down to simple maths, because if an investment falls by 10%, you need more than a 10% gain to get back to where you were. If an investment falls by 50%, you need a 100% gain to get back to where you were before. And this is what's called volatility drag. So especially in a choppy market, you could actually be losing money, because not only does it amplify the gains, but it also amplifies the losses, and that gets reset on a daily basis. So they can be useful for short-term speculation, but horrible for buy and hold investments long-term. This is a classic one, and a lot of investors fall into the trap of looking at past performance the same way that we look at reviews on a product or a service. We're trying to establish the quality of that product before we invest into it. It gives us confidence looking at good past performance, and we see that as a reflection of a good quality product. And I think it's important to remember how a company is actually valued in the first place, because all the share price actually is what an investor is willing to pay for future earnings of that company. Those future earnings have already been priced in by investors. So for a share price to keep going up, they've got to keep delivering on those earnings, and they've got to keep growing at the same pace. So if those earnings stay flat, and you buy into that company because it's had good past performance, all you're doing is buying a more expensive company for the same amount of earnings. And markets also tend to move in cycles, where last decade's winner is very rarely the next decade's winner. And we see this when we look at the global stock market versus the US stock market. And we can see over the course of history where there's been periods of 5 to 10 years where either the US has outperformed the rest of the world or vice versa has then underperformed. The big US tech companies, specifically in the Nasdaq 100, have massively outperformed the rest of the world, especially in the last 10 to 15 years. And there's nothing to say that that can't continue. But when we look at the course of history over a long period of time, we can see how cyclical the market is, and we tend to see a reversion to the mean. That doesn't mean that's going to happen in the the next 2 years or the next 10 years. But looking at the massive performance that the Nasdaq has had over the past 10 years, don't automatically assume that you're going to get that in the next 10 years. For most people, they'll be better with a simple, consistent allocation rather than a reactive one, because it takes the emotion out of investing. In investing, we're taught that we need to diversify, and that's obviously important, but for some reason we seem to hold complexity as this badge of honor. And from what I've seen, the only people that benefit from complexity are the people selling the products. I've seen ETF portfolios with 10 to 15 ETFs that are no more diversified than a simple global ETF. We touched on overlap earlier, but it's not just about that. Having too many ETFs makes it not only harder to rebalance, it's harder to track, and also there's no clear strategy. And I think simply just because having one global ETF doesn't sell that well, we're almost encouraged to treat ETFs in the same way that we might treat single stocks, in the same way that we want to diversify across multiple different companies in different regions and different sectors. We see ETFs in the same light, despite a global ETF having over 3,500 companies. There are, of course, sensible tilts that we can make. For example, if we want to have more exposure to a particular country or a particular region. Most likely not the US, because it already makes up 60% like we talked about. So you've already got a large proportion there. If you wanted more exposure to a specific company, the UK, Japan, Europe, whatever it is, you could have a small tilt where you're having a global ETF as your core holding. Then you also hold a regional ETF as well, because they have a much smaller percentage in a global ETF. But again, you are making an active decision there. So that's going to be unique to you. You might look at different asset classes that are not covered in a global ETF. It depends where you are in your investment journey, when you need the money, and what you need the money for. You might want to reduce your volatility from equity, in which case you might want to look at bonds or money markets, or even hold some money as cash. You may look at precious metals such as gold, or commodities such as oil. You may look at crypto. You may also want some investments that are specific to producing income, because you want to draw that income rather than focus on growth. But even if you were to include most of those asset classes, you're still only around 5 or 6 different ETFs. Nowhere near the 10, 15, or even 20 that I've seen in many portfolios. If you're sitting there thinking that sounds quite familiar, and you're looking at a portfolio with numerous ETFs that's really complicated, ask yourself a question about each one. Ask yourself, why am I holding this? And what am I holding it for? Ask yourself, is there a strategy here? And then depending on the answers to those questions, you can then decide whether it's worth consolidating, selling, combining, whatever it is. But just make sure you understand exactly why you've invested in what you've invested into. Let me know if there's any others that you would have included in this list. I hope you found that useful. Thanks for watching, and I'll catch you in the next one.